Ladies and gentlemen, people of the internet, welcome back to yet another episode of Crypto Over Coffee. Hope you're doing well on this fine Friday. And if you're new here, every single Friday I break down the latest news and hottest topics in the world of technology and cryptocurrency whilst drinking a cup of delicious coffee. Now in today's episode, we're talking about DeFi, Cardano staking, Bitcoin's price, a bunch more, and of course our usual 404 Logic Not Found segment. But before we get into all that, like we do every single week, let's kick it off with some questions from the community here on YouTube and as well on Twitter. So I'm going to pull those up now. And if you want one of your questions answered, of course, leave them in the comments down below or tweet me at Hashoshi4. And if you would be so inclined, please do subscribe to the channel and hit the little bell notification button so you can get a heads up whenever I post new content like this. So let's dive into the first question. Lucas Garcia, this is a long question, but I'll give you the highlights. I'm guessing that it isn't possible yet to develop smart contracts in Cardano yet, at least in mainnet. And regarding testnet, is there some way to produce NFTs? So that's a two-pronged question. No, it is not possible in mainnet to implement smart contracts in Cardano, but there is a testnet version that you can use of the Plutus language. And there should be more public mainnet style testnets coming shortly here in Q3 of the year. And in terms of NFTs, there will be a way to create NFTs, but again, that's going to have to wait until mainnet or closer to that mainnet release candidate. And if I were developing a blockchain game right now using Unity 3D, I would probably choose Ethereum still because I think Ethereum has the best developer tooling, it has the largest community, and it should be backwards compatible when Ethereum 2.0 comes out. So if you have a development trajectory, you have a timeline that's anywhere from a year to a year and a half, maybe 2 years, which a lot of games sometimes do, especially if you're starting from scratch, then you might want to just stick with Ethereum, wait for ETH 2.0. But again, that's really a personal choice. I agree the fees are just way too high right now, but you can do a lot of your development here on one of the test nets that's a lot less of a cost. So hopefully that answers your question, and thank you so much. Now, next question is from Lucas. It says, mobile wallets, I've seen several videos stating that they're not safe. Why? No one ever explains the reasons. If Wi-Fi and Bluetooth are never turned on outside of my home, the apps are off and can only be turned on by touch Face ID, I don't see what the risks are. And you don't hear about these mobile wallets being hacked frequently. So this is definitely an interesting question. I think a lot of people might have a question like this, like what makes mobile wallets less appealing from a security perspective than a hardware wallet per se? The main reason is, while you can turn the features off, there are several periods of time where your device is hot, right? It's connected to the internet, so it's not disconnected. Your phone is obviously always connected to cellular, so you're basically always interacting with the world around you. The second factor is that most devices don't have a secure way to actually store the keys themselves on board. So what happens is most of these mobile wallets will simply encrypt the key and then encrypt it with a password basically. So whenever you want to use the key to sign something, it'll do that by first decrypting your key with the password that you enter or a biometric of some kind. And then from there, what it does is then signs your transaction and sends it, right? So the keys are always stored on board. And when you store a key in a hot wallet or a hot device, you're definitely opening yourself up to a lot more problems, right? And especially if you're on some of these modern mobile frameworks like Android that allows you to do all sorts of interesting things as a developer to, put APKs on your phone or to download apps. Sometimes apps are malicious and they have permission to read from storage. So you just never want that risk. Whereas a hardware wallet, on the other hand, really only runs certain firmware. It's kind of locked down. It doesn't have the ability to sideload new apps to the device. It's locked down and it's cold. So the only thing it does is store your keys and sign transactions. That is it. And so that's why it's better as a security measure to have a hardware wallet than it is to use a mobile wallet for everything. That said, there are mobile wallets out there that are plenty good enough. I really like Evercoin. I've done a video about that here on the channel. Not sponsored by them, not paid by them. I don't even have an affiliate link for them. But I really love them because they have a YubiKey hardware key integration with their wallet, which allows you to do these things a little bit more securely because you have that cold hardware device to back up your security. So mobile wallets are fine, but I wouldn't put your life savings on a mobile wallet personally for the reasons that I just mentioned. So thanks for your question, Lucas. Great one. Scott Lawrence asks, love the content, regular tune in. Thanks very much for tuning into the channel. I wanted to get your opinion on Celsius Network and how they offer interest income on numerous coins as well as their own Cell token. I like the openness and transparency, in particular their founder. I wonder if I've come across and what your thoughts are. So yeah, I've actually used Celsius. I used Celsius early on. Their interest products are great because they are they're like a lending platform. So in the real world, outside of crypto, I guess, banks will take your money that you deposit, they'll lend it out and they give you interest, right? They just don't give you anything, right? They don't give you a lot. Celsius is kind of taking that same model, but instead of taking all the profits for themselves, they distribute some of that profit to you in the form of interest, right? So you lock your coins up in there, you get interest, it compounds, you make some money, right? But you have to obviously, in some ways, give up custody of your assets, which people have mixed feelings about. Now, the Cell token kind of brings a staking ecosystem into it, where if you contribute to their ecosystem, their network in the form of stake, then you get better rates on your cryptocurrency deposits. So it's sort of this self-feeding ecosystem of lending and earning and interest. And that's why people really love it. I agree. I think the openness and transparency is great, and I have used it. But the issue is in the US, at least up until the last time I looked at it, which granted was about 6 months ago, maybe close to a year ago, US really couldn't take advantage of the best parts of the product because we didn't have access to the Cell token, the CEL token. So I haven't really gotten to use it all that much lately. But when I did, I really enjoyed it. And then they kind of locked it down. I got emails that said, hey, you're a US user. You can't really use this anymore. You can't stake the Cell token. So anyways, those are my thoughts. I think Celsius is a great product, and they are definitely a much needed competition for folks like BlockFi. Thank you for your question. Victor Louise, let me see if I got it. This is in reference to my Chainlink video that just came out. I'll link that down below. Verifiable randomness is not itself the novelty, but it, plus the network effect of Chainlink already, will be the game changer. So basically, he's asking, the verifiable randomness functionality that I think is super powerful on Chainlink, is that the game-changing feature, or is it that they have verifiable randomness that will get in the hands of more users? And really, it's both. Verifiable randomness is something in and of itself that's very valuable. Being able to create a random value in a decentralized network that you trust. It's something that's kind of hard to do, that hasn't really been done very effectively in the past. Now, if you can do that securely and effectively, but you can also provide that randomness to a large network of different blockchain protocols, Polkadot, Cosmos, Ethereum, all these different networks out there. Icon is another one. That means Chainlink is providing this really important service to tons of different networks, which means Link token is going to be used to pay for verifiable randomness across all those platforms. And because Chainlink has done so much work to integrate with platforms and protocols from the get-go over the last year and a half, 2 years, that means that the accessibility of this protocol, this verifiable randomness protocol, is going to be pretty high. And so that's the really powerful part of this. It means that people are going to really actually get to use this in mass. So Victor, that is the reason. You are correct. Awesome. So wanted to cut down on the questions because we've got a little bit of news to talk about today that takes a little bit longer to talk about. So let's go ahead and dive right into that. Now, to kick off the news today, I wanted to give a shout out to MyEtherWallet, who are now entering the DeFi fray by supporting Aave and Ren on their platform. This means that users of the MyEtherWallet application and the MuConnect service can get access to Aave's plethora of lending products, as well as a wide variety of token pairs through Ren. Now, this is great news for the DeFi space at large, really, because MyEtherWallet is one of the most user-friendly and trusted platforms out there for users of the Ethereum network. And of course, because of that trust, I'm sure that MyEtherWallet took a while to join the party for DeFi because they wanted to do it safely and make sure that the experience was great, which I obviously respect. Security is paramount. Now, it's no secret that while DeFi presents major opportunities, it also presents significant risks, especially to those who lack experience in the space, which is fine, or those who cannot spot something that's not safe. It's important that these companies put up some guardrails to help people operate securely in this new space. Which brings me to today's 404 Logic Not Found, and for those who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And speaking of attention, if you want to help this video get some attention from the YouTube algorithm, please do hit that like button and get subscribed to the channel because it tells the YouTube robots that you're enjoying the content and you want to see more of it. So thank you so much for that in advance. Now, this really should not come as much of a surprise, but in the middle of the week this week, there was yet another hype-filled craze in the crypto space that ended in the same painful lesson that one would think we've all learned by now. Unaudited code can be a real costly problem for token holders. Now, here's the deal. You probably saw crypto Twitter ablaze with talks of YAMS. Yes, YAMS, because a DeFi yield farming protocol experiment went live under that same moniker and drew such significant interest that it managed to have over 400 million, closer to $460 million siphoned into it within a matter of hours. Less than a day, in fact. Now, users flocked to the project as it surged, trying to stake and earn and make some profit, and many did just that. They did make some profit. However, if you spent even a minute looking underneath the hood a little bit or perusing the little documentation that was out there about this hot, starchy vegetable, one would see all the warning signs that were there all along. Even the creators of the protocol made it clear that this was an experiment, an MVP, minimum viable product. The code was unaudited. No one knew if it was going to work as intended or work at all. Yet still nearly $500 million ended up inside this mess. Of course, predictably, the 24-hour feeding frenzy on these delicious yams ended in cataclysm, as the YAM token plummeted to zero after a critical bug was found in the code during rebase. And this means that anyone who hadn't already gotten out was left with a worthless pile of digital rotten yams. And big holders were the ones who obviously got hurt the most because they were holding big bags. And there's a lesson here, the same lesson that's been learned dozens of times over in this space. And it makes me question whether people in this space actually really get it at all. Things like this never, ever work out in everyone's favor. It benefits only a select few people who get in early, make money, and get out. It's quite literally the perfect analogy for a game of hot potato, in this case a yam, where if you get caught holding that sucker when everyone else leaves the party, you're the one who's going to get burned. And the only person to blame for getting caught with that hot potato, or yam in this case, is the person holding said yam. When you see something labeled as an experiment by its creators, when it's something that's marked as unaudited code, and you still dump money into it expecting no real risk and only profit, that's just unwise. Warning signs were everywhere, and the one-day peak and subsequent implosion of YAM should be really no surprise. So let today be the final lesson. Do not go all in on an experiment with unaudited code. You probably could make a profit, but at a massive, massive risk on the other end. So 404, logic not found. This space has to learn this critical lesson, because I hate it when people get stuck holding a bag of nothing and losing money just because they got unlucky and jumped into something that wasn't there. So in other news, my friend BitBoy broke a story the other day about a scam that cost his friend tens of thousands of dollars. I wanted to share that with you so that you can be aware of it and obviously keep yourself safe. So hackers are now running Google ads to put fake exchange sites and decentralized exchange sites up on the internet at the top of search results on Google. The idea is that many people will click on the first result, not thinking about it, not looking, which of course happens to the best of us, and then they'll either try and log into their account, at which time the hacker steals their credentials, or worse, they will transfer crypto to the fake DEX and the hacker takes control of crypto. The most prominent one right now, which is the one that BitBoy reported on, is a fake Uniswap site that is the first result on Google. Obviously, that's the entire point of this hack. Inevitably, people will click it thinking it's Uniswap, and then they'll transfer crypto, and of course that goes straight to the hacker and not to Uniswap because it's fake. So how can you protect yourself from this? The way that I do this is that I have a checklist that I get into the habit of following whenever I go to a sensitive site or create an account. Things like banks, exchanges, etc. First, when I sign up for the very first time, I write down the URL or domain that the official site uses in my password manager. I also note the certificate authority and certificate information by clicking the little lock icon in my browser's bar. I then favorite the correct site, the site that I just signed up on, so that I know it's the correct site. So from there, whenever I go to those sites, I only ever use the favorites that I saved, and I never go to Google or hand type the URL, because that's when mistakes happen. If I do happen to use Google or hand type something because I forgot, whatever, I always check the URL and certificate before I do anything, because it will always throw up flags if something is off. So please be safe out there. Always verify the site you're using before you put anything sensitive or send crypto. That's just a rule of thumb. Now, I read an interesting article in the world of Cardano that discussed the opportunity for stake pool operators to run their pool like a business. In other words, there are some stake pool operators that are already structuring their operation as a profitable service that can earn semi-passive income. And ADA holders can obviously get in on the fun as well by staking or delegating their ADA. The core design of the proof of stake protocol that's now live in Cardano's mainnet is that those who operate pools and secure the network should be rewarded for doing so. And then also, individual ADA holders who delegate to those pools should also in kind be rewarded for their participation. This helps the network become more secure and more decentralized. So it's not a surprise that stake pools are trying to optimize their operation to attract the maximum amount of ADA from individuals and to contribute the most to the community, as that in turn maximizes the rewards they receive for that work, both intangible and tangible. Now, I would expect that as the mainnet implementation of Shelley unfolds fully throughout the month of August, we will see the true results and metrics that these staking operations are seeing, and I'll report back on that when I see it. Now, in the world of Ethereum, gas fees hit new all-time highs yet again this past week, with congestion on the network from DeFi and stablecoins taking up precious block space and compute resources on the network. So this drives up the average price of a transaction, and this week we hit $7.50 per transaction on average, according to data from Blockchair, the block explorer or blockchain data provider. Needless to say, this is not good and not sustainable for anyone that uses Ethereum for virtually anything. Now, in response to this mess, Vitalik Buterin called for an overhaul to the pricing model for transactions and operations on the network, which, of course, he correctly asserted must be done to protect the security of Ethereum itself. Now, the problem at hand here is when transactions are costing so much, miner attacks can be more prevalent or incentivized when there's a high fee base on transactions. This is because the total reward and fees for a block may at some point outweigh the block reward value at a given time and then encourage selfish mining. So obviously this is a real problem. There is a current Ethereum improvement proposal number 1599, EIP 1599, which would first raise the overall threshold for gas inside one block from 12.5 million up to 16 million, which subsequently increases the space inside of a block for transactions and reducing fees therein. And then effectively, it would burn any base fees depending on network capacity, so that miners weren't just collecting all of these fees as profit. Theoretically, this means that miners would in turn become less reliant on gas as a means for profit, and it would kind of negate the problem of selfish mining, as they'd only receive the gas premiums paid for expedited transactions rather than the base fees. Now, this is hotly contested, though, because it lacks the robust testing and, validation that would prove that there wouldn't be unintended consequences or that this functionality would behave as it was intended. So I'm personally torn on this one. I do think the gas threshold should be increased. I don't know by that much, but I don't love the idea of base fees being burned unless it can be tested first, because I get it in theory, but I don't know that it'll always work the way they think. So we shall see, but something needs to be done. And as always, let's do some Bitcoin price analysis. So first of all, this is the third week in a row that I say I'm pleasantly surprised at the high prices we're testing and seeing on Bitcoin these days. That's a given. I really don't know why history has not repeated itself with volatility and price drops in July and August, but this year has seen rather unprecedented growth and low volatility during this time period. I do think that the surge in altcoins has also helped Bitcoin stay up where it is, because profit takers are probably moving into Bitcoin during trading if they're not already moving into stablecoins. Now, Kraken, the popular US-based exchange, released a report recently that predicted a 50 to 200% growth trend for Bitcoin over the next handful of months, so still in 2020. The report backs this claim by saying that the shirking of the volatility and price drop trend for this time period in years past lends support to the price growth trend moving forward. Furthermore, momentum of this past month's growth might carry Bitcoin higher from here as well. So it's this growth trajectory that they're talking about. Now, I would say that it's probably a 50-50 shot whether this comes to fruition. And to be honest, most predictions are rather baseless because they're in fact predictions. But what do you think? I'll leave it in your hands. Where are we going from here with Bitcoin, and what are the value drivers, do you think? Now, I will say what is most interesting to me, though, is the near record high levels of correlation between Bitcoin and gold, which during this whole global economic mess is kind of promising for Bitcoin's pitch as a safe store of value during high inflation periods for fiat currency. I think that Bitcoin has really made its case for being digital gold, or I guess better than gold in reality during this time, especially because those who have moved from cash to Bitcoin or gold to Bitcoin have done exceedingly well by and large. Now, in Europe, Germany just launched a legislative effort to bring blockchain technology to the forefront by proposing a bill that would give both A, regulatory clarity in terms of the usage of the technology, but also B, it would provide legal status to digital securities issued using blockchain tech and replacing paper certificates for securities. This is obviously exciting news and something that the United States and Canada, for that matter, should be rushing to replicate. In the US especially, we need regulatory clarity and more opportunities for this revolutionary tech to be used without penalty. There's too many instances where people are just hitting so many barriers in the legal front to even make a project that does anything. So that needs to change. Regulatory clarity is key. Now, folks, if you have some time to stick around, please do check out this video. I'll link here that I just released about a game-changing Chainlink feature that I think people really need to know more about. But of course, thanks so much for watching this video, and I wish you and your family a fantastic weekend and week ahead. And until next time, cheers.